Hello everyone, welcome back to the channel. So yesterday I was reflecting on a conversation that I had with a close friend of mine in 2021, and at the time I was explaining to her why long-term stock market investing is a better choice than having all of your money in a bank account for decades. And she understood the principles of what I was saying, but she just couldn't buy into the idea that she could be successful doing it. And this is a recurring theme that I see when I talk to people who are totally unfamiliar with the investing world. Once explained, they understand the concepts, but they lack the conviction that when applied in practice, it will work out for them. A lot of that has to do with psychological factors like loss aversion bias, where we as humans have been found to experience the pain of losing money twice as intensely as the pleasure of making money. So for someone who has no real understanding of how long-term stock market investing plays out in practice, it's only logical that their mind would sway towards the worst case scenario, one where they end up losing all of their money. And because of loss aversion bias, this is a truly terrifying prospect for many, and they will run as far as they can in the opposite direction to avoid it. But those of us who understand long-term investing will know that this fear is totally irrational. It's irrational because the data has shown that over long periods of time, your chances of losing money in the stock market are virtually zero. But it's also irrational because money in a bank account is guaranteed to be worth significantly less in 20 to 30 years time thanks to inflation. So by not investing out of fear of losing money, those same people are unknowingly guaranteeing their own demise, and they're subjecting themselves to a much worse financial fate than what sensible stock market investing would have provided them. However, beyond the irrational fear of losing money, I have identified one other major reason why people are apprehensive towards investing. People don't know how to be good at investing, and they have a misconstrued understanding of what good investing looks like. Even though an individual might be unfamiliar with the investing world, subconsciously they do have some form of an interpretation of investing. That interpretation was likely formed from Hollywood movies, fragments of various conversations within their social circles, and a whole host of other contributory factors. Generally, it involves screens with flashing numbers, charts, and other complexities set in a high-intensity environment. In that context, good investing would involve some sort of mastery of this chaos. However, this is nowhere close to the reality of investing, specifically long-term investing. But before we delve into what that reality looks like, there's something to be learned from that uncertainty within people of not knowing how to be good at investing. You see, individuals not knowing how to be good is the exact reason why their understanding is misconstrued in the first place. It assumes that there's a skill gap between the best and the worst. One might assume that the best investors make all the money and the worst investors lose all their money. One might also assume that in order to be the best investor, you would need natural ability as well as extreme drive and passion to achieve that status. And even though that's often how it works in our jobs and the sports we play, it's not how it works when it comes to investing. Again, specifically long-term investing. I would go as far as to say that there is no such thing as the best and worst investors. There are only people who have an understanding of why they're doing what they're doing, and you either have that understanding or you don't. The reason why I believe this to be true is because if I was in a room with 50 young people who all understood the basic principles of long-term investing, I'd be willing to wager that the vast majority of them would end up congregating in the same investments. In other words, they would all invest their money in more or less the exact same thing. So if the majority of investors can agree that one particular type of investment makes the most sense, then there is no skill gap associated with picking investments for long-term investing. At that point, the only major factors that separate one investor's performance over another are time and money, i.e. how early you start and how much you invest. You have total control over those two factors. You don't need natural ability or extreme drive to optimize either of these. Sure, some people are going to be in a better financial position than others, giving them a greater ability to invest. But ultimately, that doesn't matter. You're totally free to go at your own pace. The lesson is that there is no skill gap associated with long-term investing. It's as easy as your decision to keep all of your money in the bank. But unlike the bank, it offers much greater rewards. years. So what does the reality of long-term investing look like? What exactly are the investments that the majority of long-term investors are congregating in, and why? For the vast majority, long-term investing should exclusively involve you putting your money into low-cost index funds. Now, this is something that I mention frequently, and even though it might seem like I'm beating a dead horse, the reason why I continue to emphasize it is because it is literally the answer to what you're looking for. Investing in low-cost index funds has not only been proven to be the best and most efficient way of investing over long periods of time, but it also requires no time commitment on your part. In fact, you don't even need to understand how index funds work to be successful, nor do you need to understand any of the complexities of the broader stock market or even what's going on in the macroeconomic environment with things like interest rates and inflation. Personally, I would like everyone to have a basic understanding of all of that, but if I'm being brutally honest, it's not required. All you're doing is depositing money into index funds each and every month for 30 to 40 years, and the data has shown that if you do that, you will be successful. This is why there's no skill gap associated with long-term index fund investing. Now, you might say, I don't feel comfortable putting my money into something that I don't understand, to which I applaud. And I'm not saying that you should do that. There's plenty of resources here on the channel that will help you to build up that understanding. All I'm saying is that you could very well get away with not having that understanding and still be successful. Warren Buffett himself famously once said that by periodically investing in index funds, know-nothing investors can actually outperform most investment professionals. That's what people don't understand. Long-term index fund investing is so reliable, yet so incredibly simple that it can allow ordinary people to earn better returns than investment professionals. No prior experience or significant time investment required. That begs a very sensible question. If index fund investing is so reliable, why doesn't everyone do it, including the investment professionals? It's widely accepted that if the entire investing market swapped to index fund investing, then index fund investing itself would become inefficient. But as Ben Felix notes in his video, The Index Fund Tipping Point, this is unlikely to happen provided there are at least some remaining informed investment managers competing to bring information into stock prices. The incentive to do so is that as competition decreases, money-making opportunities will increase, which gives those remaining managers the pick of the litter. This will allow them to not only make more money for their clients, but also for themselves, as they generate larger fee income from new and existing clients. Long story short, I think you would be foolish to not invest in index funds simply out of fear that index funds will one day become inefficient. I do want to circle back to the point around not feeling comfortable putting your money into something that you don't understand. And I would just ask you to reflect on the following question. Why is it that you feel comfortable leaving your money in the bank? Do you feel that you understand the banking system and how it works, and based on that understanding, you've decided that you're comfortable placing your money in that system? Or is it a case that you've never really questioned it before because everyone around you is doing the same and it's all you know? I would say that for the vast majority of you, the second answer is closer to reality. And if that's the case, do you not see the hypocrisy? You're telling yourself that investing isn't for you because you don't have enough understanding to feel comfortable putting real money on the line. But yet, you've no problem keeping literally all your money in the banking system, which, let's be honest, you don't understand. And here's the irony in all of this. You're apprehensive towards investing because you don't want to lose money, so you keep it all in the bank. But yet, all of the data tells us that over the long term, keeping money in the bank is the most surefire way to lose money because of inflation. Conversely, long-term investing in index funds is the most surefire way to make money. And if you're someone who in the last 2 years got sucked into the cryptocurrency hype and put money into the crypto market, don't even tell me for a second that you're not comfortable putting your money into something that you don't understand, because that is the ultimate hypocrisy. Before we conclude this video, I want to briefly contest the point of the know-nothing investor that Warren Buffett referred to. As we've already outlined, there is no skill gap with long-term investing. There is no best and worst. There are only people who understand why they're doing what they're doing, and they can demonstrate that understanding by investing in index funds early and consistently increasing the size of their investments over time. Because of that, long-term investing is very accessible. Anyone can do it. So imagine you had an individual who had as much blind faith in long-term investing as the general population has in the banking system. They don't question it, they don't want to understand it, they just do it. That's the know-nothing investor that Buffett is referring to, and if that individual committed to that practice forever, they would be successful. But here's the problem. We as a society are nowhere near the point of having blind faith in long-term investing. Not even close. I'm talking about getting to a point where young adults entering the workforce for the first time know that a percentage of their weekly wage is going towards index funds. They don't necessarily fully understand why, but that's what all their friends are doing and their parents too. It's second nature, just like bank accounts are today. That's where we need to get to. But that's a very distant future. For now, if an individual chooses to take up long-term investing, even though they are making the right choice, they will be seen as an outlier in society. Friends and family will question their decision. They will make them feel uncertain, especially when the stock market is down. All of this promotes an emotional response. It brings a temptation to sell, to get out of the game. That's why a true know-nothing investor would have a hard time existing in 2022. Yes, in theory, if the investor was a recluse and never paid any attention to the news, they could be successful. But most of us exist within social circles, and we are subject to the pressures of those circles. So while Buffett is correct in saying that a know-nothing investor could be successful, I think at this early stage of the game, every long-term investor needs to have at least some baseline understanding of why they're doing what they're doing, even if in a perfect world it's not required. And the reason I feel it's required in this not so perfect world is simply to have the perspective needed to resist the urge to give in to emotions. Because at the end of the day, all you need to do to be successful is buy and hold, never sell. And the only reason you're ever going to sell, bar having an unexpected need for cash, is because of your emotions. So don't let it happen. So I hope that I've given you something to reflect on with this video. If you did find value in what was discussed and want to see more content like it in the future, make sure you subscribe to the channel. It is totally free to do so. Also, consider sharing this video with family and friends. The only way that the necessary shift in attitude towards investing is going to happen is by starting conversations, and you are the key ingredient to those conversations. As always, thanks very much for watching, and I'll see you in the next one.